Hi guys, welcome back again this week. Most of you will have noticed that last week the episode didn't appear. The reasons for that were we produced last week's YouTube video for you guys. We got it back from Edinburgh and we realised we weren't quite comfortable with what we were saying. It was very much orientated around how to profit from war. In the time it took us to get the Edinburgh back, the casualties were building in Ukraine, and it put us in a very difficult situation that it just felt ethically wrong that we were kind of trying to tell people how to profit when there was such an ongoing and worsening humanitarian crisis. That didn't really sit too comfortable with us. Had the situation been different and there hadn't been so many casualties, perhaps, but what we really should have done was just tone it down a little bit. But here we are, we're back again this week with a lot of important stuff to get through as always. So we'll get on with the economic data for this week, and it's been a really important one. There was really only one data set that anybody was bothered about this week, and that was the CPI data out of the States. That number came in at 7.9%. It was 0.1, 0.2% down on where we had it. We did have it as an upper estimate, potentially at 8.1%. A lot of people would be thinking, how's that coming quite so low? In the big scheme of things, it's not a low number at all, but how was it not higher when you're looking at your rising commodity prices? You've got to remember this data is backwards looking, so it only captured oil price, especially for February. Now, the month of February, the average price of a barrel of oil traded at $92. Obviously, that is now trading an awful lot higher. It was only during the early hours of Monday this week we saw it go to $138 a barrel. So that will be captured in future releases. Already through March we're averaging $112 a barrel. So as you can see, the number was the correct number, but the reasons why people might have anticipated that number being higher were based predominantly on the price of a barrel of oil. The reason we're touching on the price of a barrel of oil is because it is so important to what happens next. We've got the Fed interest rate decision March 15th. We'll touch on, we've changed our minds a lot about what will happen as the situation changes. But basically we can begin to model three different options around the price of a barrel of oil. We've been through above $100 a barrel for a couple of weeks or so now. I think there's maybe expectation that all of a sudden this quickly pulls back. That is never the case. When oil goes through $100 a barrel, it will stay at them elevated levels for a lengthy period of time. And we're so, basically, I think we've discussed in previous episodes, we believe we're at the beginning of a super cycle when it comes to commodities. We don't see the price of oil easing at all along with other commodities. So we can look at three models from that. At sub $100 a barrel, you can still expect around about 4% growth a year. But obviously it will still add to inflation. And that $100 a barrel, what you would expect to see as we look to March 15th for the Fed rate decisions, they would potentially front load the interest rates. You would have, I think if it had gone sub $100, you would have seen that quite aggressive half a percent base increase on the price of your interest rates. Moving to $100 to $125 a barrel, that sees global growth, especially in the US, but global growth in general, slip to around about 2.5%. At that point, the Fed would base their interest rate decisions roughly at 25 basis point increases, and you could expect around about 7 throughout the year. it's when you get to the upper levels on the price of a barrel of oil at 150 plus, this is where we have real problems coming in. At $150 a barrel, the United States is going to slip into recession. The Fed would have to react to that. You'd have, again, the front-loaded aggressive increases on rates, and then that would be eased throughout subsequent rate decisions. And the rate decisions would come quite late in the year. You'd be looking at 5 rate hikes at 25 basis points apiece through kind of second half of this year. You've still got a lot of analysts saying that inflation will ease, but the numbers they're throwing around is basically an 80% chance of moderating through the second half of the year. An 80% chance isn't a chance. It's not statistically significant in any way, shape or form. At 80%, it's nothing other than a guess, and we see it as more of a hopeful guess. Going back to the oil price, we have the average price of a barrel of oil throughout 2022. We are bang on $135 a barrel. Your oil traders potentially see this a little bit different. You have some lower estimates at 180. You have estimates as high as $300 a barrel. We don't see the average of them at such extremes because at some point you get the demand just dies out. And obviously we are heading into that period of very high demand for oil for travel across America during the summer months. But that demand will essentially die out at the very upper estimates. So we're sticking with 135 a barrel throughout this year, and of course that puts us right on the cusp of the lower growth estimates bordering recession. I think it's too early to say we will slip into recession, but we're very much on the cusp at this point. So a lot of regular followers will know we started touching on this back as far as probably October, November last year, where regional differences were starting to appear. And that's actually rare. I mean, you have the VIX indicators as what will happen, but geographical differences are equally as important. And there was outbreaks of when one region was going one direction, we had other regions going another, and that really is rare in the big scheme of things. And it just goes to show how quickly things change. We had only a matter of weeks ago, Europe looked like a great investing landscape, whereas the FTSE and the UK indexes looked incredibly overpriced. It's then geopolitical issues that came to the front have changed that dramatically in a matter of only weeks. Right now, Europe does have a lot more downside. I think right now we're at, European indices are roughly 6% down on the month, around about 14% on the year. What you guys need to be looking out for is that we are seeing credit spreads widening. That is a huge indicator of default stress. Obviously, a lot of the reason Europe is under so much pressure is that they're a huge oil and gas importer from Russia. Around about 40% of Europe's oil and gas comes from Russia. So that's where this is generating, and that's where we see the volatility within Europe at the moment. It's almost changing on a day-to-day situation. You will start finding that the FTSE and the UK markets will act as an outlier. I know a lot of people, I get a lot of messages about the crazy things that have happened in Europe and in the UK, and it doesn't have quite as much downside exposure. So we've seen these days recently where European markets have moved 3-4% in one direction, and the UK has been around about 2%. That's something we can expect to see ongoing for a prolonged period of time. So it's time for Andrea to take everyone through some equities for this week. We're going to begin by focusing on, there's obviously a lot of equities that have been caught up in crossfire for want of a better term over with the Russia-Ukraine situation, and I think Andrea's going to talk you through a couple of them, focus mainly on airlines and car manufacturers. And of course we always try and finish off with a couple of requests. I think we've only really got one request from this week, so we're going to try and deal with that in quite a lot of detail.
We will in future episodes look at opportunities within Russian equities when hopefully we see more peaceful times. But for now, we will look at a few companies caught up in the conflicts. This was our strongest car manufacturer play until recently. They've got great earnings release and zero statements. Renault has a direct exposure to Russia, around 12% of revenue generated there. And obviously, we need to react to that. And we have actually revised our guidance from plus 40 euros to 32 euros a share. The current price action is another reaction. 37 euros a share down to current 22 euros even on the revised balance sheet. The stock looks cheaper than ever. Renault isn't the only car manufacturer that's been caught up. It's not just a selling unit by many. People don't realize a lot of key car components come from Ukraine. Altogether, the total impact will be a reduction of around 3 million units across the industry. Volkswagen has seen their share price ease back to 143 from their yearly high of 193. They have supply chain issues and tough market condition. They will see a balance sheet revised negatively. 2022 will see a net income still at 14.9 billion from 20% gross margins. Their numbers essentially put us back comparable with 2019, where the underlying price is actually very similar. There's no need to panic sell any further, but it's also not a great buying opportunity right now. Airlines have had an awful time. People have speculatively bought over the last 12 months and it's simply a mistake. There's been some restaking that was simply not be justified with any profit. Airlines are now under serious pressure with the current oil price and with household disposable income becoming squeezed. All the airlines right now look expensive. IAG now sits on 20 billion of debt, and their whole profitability will return in 2022 at 95 million, but the oil price puts pay to that. It will be another yearly loss as gross margins are squeezed and revenue revised down to 14 billion. Current asset price at 132p should be avoided as we see a further downside of another 50%. United Airlines are similar. They have a debt up to 40 billion from 20 billion in only 2019. 2022 gross margins are less than 1%. That means losses once again through the $1 billion barrier. That's 19 billion of losses since pre-pandemic. Their asset price could actually see the low $20. Now we've got EasyJet. EasyJet is the last airline company we're going to look at. We do have them in a better position, and the current price at 480p looks actually competitive. It's down from 700p only in February. We still have 2022 revenue at 5.1 billion with a gross margin slipping to 15%. It's a 2022 net profit if only very slightly. EasyJet are actually now the airline peak for those looking to add one to their ISA. One request to deal with this week is BUNZL. On the whole, the stock is fluctuating with its exposure to the wider UK index. The stock is 60% institutionally held. That's below the levels need to avoid the stock trading at lower levels. And funds have sold out through 2022, but only marginally for a net change of minus 2%. One of the biggest risks right now is the exposure to currency risk, and this could worsen over longer horizons, shorter horizons. Short interest has seen a large uptake through February, 6,400 shares short by month end. It's an increase of more than 1,000%. There's also many positives, like dividend yield above 2%, forward earning multiples are actually competitive, although we do expect that to slip a little bit from the current 20 to 17.6. 2022 revenues are up 4.9% year on year, while growth margin maintained at around 25%. Altogether, that's 540 million of net income with EPS at 1.59. There's lots of offset against headwinds. That just means there's an element of debt money to hold in.
So thanks everybody for watching. Apologies again for last week. If we find ourselves in the same situation, we will rein it in slightly on the more ethical side. We do understand investors need kind of guiding through these difficult times, and we will continue to do that. I think we've only covered one request this week, but in general, you guys get in touch. We will do our best to deal with them, and we hope everybody has a great week.